Hey folks, hope you're having a fine day. Here, we're back again with our latest video, and this time we'll be discussing how to invest. Investing can provide you with another source of income, fund your retirement, or even get out of a financial jam. While investing can help you develop wealth, you must balance potential profits with the risks involved. Professionals examine assets not just for absolute return potential, but also for risk-adjusted return. The basic line is that not all returns are created equal, and wise investors look to invest where they can receive the best value for the risk they're willing to take, even if that means accepting lower returns. There are several ways to invest, ranging from quite safe to extremely risky. Here are some financial investments methods that can be useful for you to secure your future. Hey, if you haven't clicked the subscribe button yet, so hurry up. Press the bell icon for more updates, comment, like, and share it with your loved ones and family. Let's get started. Number 5 in the list is high-yield savings accounts. A high-yield online savings account gives you profit on your cash balance. Moreover, like a savings account yielding pennies at your local bank, high-yield profit savings accounts are accessible vehicles for your money. The high-yield savings account is pretty much the gold standard of safe investments, offering you strong returns given the total absence of risk. The money you have stashed in almost any bank is insured by the Federal Deposit Insurance Corp., meaning the government will make you whole on any losses up to $250,000. One of the few catches with high-yield savings accounts is the rates can change in response to current market conditions. When rates are falling, payouts can seem not as attractive. Rates have been creeping up since early this year, and top high-yield savings accounts are paying over 3% for the first time in a few years. With the national average savings rate hovering at 0.35% as of February 21, high-yield savings accounts are a great deal. Although not as exciting as potential stock market returns, high-yield savings accounts are very liquid investments, which means you can get your money quickly and without penalty. That makes stashing your emergency fund, which you should have if you're serious about limiting your financial risk, a pretty good investment. FDIC insurance means your money is 100% safe. It's simple to obtain in an emergency, and the rates are significantly higher than the national average savings account rate. It's best for storing your emergency fund for investors looking for low-risk options. For the best rates, check out Bankrate's list of the best high-yield savings accounts. You can also go to your local bank or credit union, though you might not get the best rates. Let's move on to number 4, certificates of deposit. Savings accounts and certificates of deposit are nearly identical. Most are FDIC insured, so there is no risk. They are, however, still liquid. When you invest in a CD, you accept a time horizon, which can range from 1 month to up to 10 years. Although some CDs allow you to withdraw your money without penalty, you will usually have to pay a penalty if you access your money before the CD term ends. On the one hand, this reduces the value of CDs as an emergency fund or savings vehicle. On the other hand, it should imply that you will be compensated with a higher rate of return in exchange for the loss of easy access. Essentially, banks will have an easier time reinvesting your savings if you promise to leave them alone for a set period. In exchange, you should get a better rate. Before you get a CD, consider the following: whether or not you will need the money before the CD matures. If you answered yes, you should look elsewhere. Whether you're truly receiving a higher profit rate than that offered by high-yield savings accounts. The only advantage of a CD over a savings account is higher returns, so if you can find a savings account that pays more than the CDs at your bank, there's no reason to use one. It's best for those who won't need money in the specified time frame, and investors with a stable financial picture who want to avoid risk in their investments. Let's talk about number 3, money market accounts. Money market accounts work on the same principles as CDs and savings accounts. They usually have higher profit rates than savings accounts, but they also have more liquidity and may allow you to write checks or usually a debit card with the account, giving you more flexibility when used in conjunction with a savings account. If you only use the account to make deposits and write a monthly rent check, for example, the MMA may be ideal. However, the return is everything. So shop around and compare your options not just with other money market accounts, but also with CDs and high-yield savings accounts. Also, keep in mind that the main disadvantage of a money market account is that many banks impose a monthly transaction limit of 6 transactions. If you go over, you'll be fined. If you keep going over, the bank will have to convert your account to a checking account or even close it. It's best for those who need money only on occasion. Investors seeking a little more flexibility than their savings account provides. Moving on to number 2, rental housing. If you're willing to manage your properties, rental housing can be a great investment. To go this route, you'll need to find the right property, finance or buy it outright, maintain it, and deal with tenants. If you make wise purchases, you can do very well. With housing prices expected to fall in 2023 and mortgage rates near their all-time lows, a strategic real estate purchase could pay off in the long run. It's good for long-term investors who want to manage their properties and generate consistent cash flow should consider investing in rental housing. It may still be a good time to finance the purchase of a new property, though the unstable economy may make it more difficult to operate. When it comes time to retire, if you hold your assets over time, gradually pay down debt, and grow your rent, you'll most likely have a strong cash flow. To find rental housing, you'll most likely need to work with a real estate broker, but you can work on developing a network that may be able to source you better deals before they hit the market. Now, last but not the least, is number 1, government bonds. A government bond is a loan made by you to a government entity, such as the federal or municipal government, that pays investors profit over a set period, typically 1 to 30 years. Bonds are classified as fixed income security due to their consistent stream of payments. Government bonds are almost risk-free investments because they're backed by the full faith and credit of the United States government. What are the disadvantages? Government bonds, in exchange for their safety, do not provide as high a return as other types of investments. It would be much more difficult to meet your retirement or long-term goals if you had a 100% bond portfolio rather than a mix of stocks and bonds. For more information, see our bond explainer. It's best for consecutive investors who prefer a lower level of volatility in their portfolio. Bonds provide ballast to a portfolio, usually rising when stocks fall, allowing nervous investors to stick to their investment plan and not panic sell, says Dalia Fernandez, a certified financial planner and founder of Fernandez Financial Advisory in Los Alamitos, California. Bonds are popular among investors nearing or already in retirement due to their fixed income or lower volatility, as these individuals may not have a long enough investment horizon to weather unexpected or severe market declines. Individual bonds or bond funds, which hold a variety of bonds to provide diversification, can be purchased through a broker or directly from the underwriting investment bank or the United States government. Our primer on how to invest in bonds will assist you in determining which types to buy and where to buy them. Thank you for watching. If you find this video informative, so don't forget to give this video a thumbs up and comment below the best part of this video that you like the most and what you think about your future investment.